nice con.
All right, everybody, we are back. It is episode 90
Yeah.
of the Pickers Market. I can't believe that.
Getting close to a century.
Yeah.
Yeah, wow.
You're nearly
flies.
triple digit here.
I know, that's crazy. So we've got the dream team here, Keith, Kyle, Lisa.
Dream team, I like that.
Dream team, yeah. It's hard to remember what day it is. I was just on vacation, so it's Wednesday.
So you're still in the vacation bliss?
I'm still, more like the fog.
The fog,
the
yeah.
fog of
both
recovery.
you two were.
Yeah.
Oh yeah, I guess you know what, you were in what, San Diego?
Yeah.
How was that?
Oh, it was fantastic.
I bet it was. So especially with the cold here.
I sucked up all the
She came back with a nice
sun
glow.
and the warm weather that I get.
Yeah.
Left her husband behind, so it was a girls' trip. So it was
Oh,
even
girls'
even
trip.
It was a
that's
girls'
better.
trip, yes.
Yeah.
Surprised you made it back.
Yeah.
Kyle went skiing.
So I went, was in the mountains skiing. It was fantastic. And they got like the most snow of the season. So it was like 14 inches. We saw Beaver Creek.
Which is nice.
Yeah, it
And
was
you have like
overnight.
the powdery.
Mhm.
Was it fresh snow?
It was brand new,
Ooh,
fresh
nice.
snow. It was great.
Mhm.
So it was very fun.
Don't worry, I was still here working.
Yeah, you had to
Keith
keep the
were
lights
like-
on. You know.
Keith kept the lights on.
Yeah. All right. Well, we'll get into it. Classic Two Truths and a Lie. Earnings season is underway. And so I thought we'd start with that and then continue on to a semi-related topic that we'll dig into. So I guess we'll just kick it off. So A, volatility usually rises in the 2 weeks around a company's earnings date. B, earnings reactions are often larger in Q1 and Q3 than in Q2 or 4. And C, earnings reactions are strongest when interest rates are low. Keith,
Wow,
what do we think?
that's a good set of questions and
Notice how there's no numbers in there?
Wow, yeah, you got Q1 and 3. And
Well, yeah,
Q2,
that one's a
that's-
little squirrely.
Yeah,
That's a little random to me. But
So I'll start reverse order. I'm gonna go C. Earnings reactions are strongest when interest rates are low. I think that seems valid. So if you got interest rates low, there's a little more volatility and kind of long dated, which are stocks. So I'm saying that one's gonna be true. And volatility usually rises in the 2 weeks around a company's earnings date. That would seem true, but I'm going opposite. I'm gonna say that one's false, and you're Q1, Q3, Q2, Q4. I think I can't add anything there. I'm just going with that's true. Lisa.
so volatility usually rises around the earnings date, yes, because everyone is trying to get their bets in or out after, whatever. I can see C as well, like earnings reactions are strongest when interest rates are lower. Yeah, I think you did something with B because earnings reaction are larger in Q1, Q3 than Q2 and Q4. That sounds random to me, and I would not know why, especially in those 2 quarters and not in the others. I also cannot recall.
Okay, so you're both going with B?
I went with A.
A.
I went with B.
Okay.
So
I got you
split
both.
decision.
You what?
It's C.
Really?
Yeah. I know that was a
Wonder why
good
that
one.
is, Yeah,
Good one,
I would have
yeah.
figured with lower interest rates, you get more.
I thought the exact
movement,
same
right?
thing, and I was very
Yeah.
surprised. And I was like, "This is gonna get them." I don't need.
Do
I
we
don't
need
need.
to fact check that?
You
by
can.
any chance?
You definitely
Lisa will
can.
fact check next.
You definitely can.
or next week's episode.
You know what I did? Because I was doing some regular reading for the other ones, and I saw those, and then I was like, I need a good lie on here. So I went to the old Chat GPT, and I said,
Did you give yourself a lie in there too? Is that how you?
Yeah, well,
phrased it?
yeah. So I said, give me some interesting stats around earnings season, and I came up with very benign, too easy.
Yeah.
I'm like, I'm gonna lose this one, and then I was like, do it, but evil, and then it replied
Really?
that for me. Yeah. So
I guess no.
Do it, but evil. That's the prompt of the of the day. I
Yeah.
would say. Okay.
Yeah.
Okay.
Well, Lisa's always using that one.
well, yeah, I probably shouldn't
So
have
my
done my
Chat-
secret sauce. Now she's gonna make
You
it
know,
super
my
hard.
Chat GPT is trained to be evil by now. It's like it's just
You don't even need
it
to put
gets
that
out
in there.
the lies.
Yeah.
I didn't put that in there. Yeah, burlap. It is not necessary anymore. It knows
Yeah.
me too good already.
Yeah. Well, on that note, I'm glad I got you both, because I feel like you've both beaten me the last couple times I've done it. So anyway, so earnings, we'll parlay that into the word of the year so far. Now that earnings are underway, this is directly related. We've seen a pretty tremendous broadening in the equity markets. So breadth, I saw a very interesting chart. The market breadth S&P 500 is outperforming the index year to date. So it's the in terms of the percentage of S&P 500 stocks outperforming the S&P over the calendar year, it is the second highest percentage in the last 30 years, which is crazy.
Wow.
That is interesting.
So the first highest was in 2002,
Mm-hmm.
and then back.
So it was after the tech wreck.
Right after, right after .com bubble, kind of came back with a fury, and then all the way back to 1970s.
Mm-hmm.
So
even before me,
it's really crazy. So if that's if it's sustainable, be the second highest in 30 years. So building on that momentum, what we've seen is really SMID cap, small mid cap companies. And non-US markets have generally outperformed. We've seen that. And going into this year, which you follow closely, is precious metals. I mean, silver and gold have been just on a tear.
Crazy.
The parabolic chart is just nuts. You have to look at it on a log basis now, because it's crazy. So I thought we'd talk a little bit about this market broadening dynamic that we've seen, because one, that chart that I just noted is very unusual. And then two, it's been so concentrated in the Mag 7 names over the last year plus, last 2 years really, since the AI trade really took hold. We've talked about it all throughout the year. Market concentration, so almost 40% in these names. AI bubble, everybody's concerned, everybody's worried. And now we're actually starting to see this rotation. And the question is, if the bubble pops or if it doesn't, like what happens? And we talked, I think a couple months ago, maybe it was around Thanksgiving, about, do bubbles always pop? And the answer was no. There was gold in the 70s that didn't, and then there was Japanese real estate that unwound slowly over decades. And so I think this broadening dynamic is interesting to just refresh and say, okay, well, what does that look like? And there's really three kind of episodes that can differentiate a path forward for us in terms of this continued dynamic of broadening. And I guess I'll frame it in two different avenues. The first is animal spirits. So that is, that hype around the market and that multiple expansion in the price over the earnings. So kind of separating the excitement and momentum of price versus what we always say is, cash is king, kind of corporate earnings drive markets. It's two different avenues. So the first would be, how does the broadening, kind of continue? And the first would be valuations, so that animal spirits, so largest stocks, so the Mag 7 would catch down. So we saw that in 2001 with the .com bubble, bursting. The second would be a catch up, so everyone else kind of growing into, or the animal spirits expanding in terms of the valuations for, to catch the Mag 7. So we saw that in 2003 and then 2009 and 10. And then the third type, which I think is most likely, is is earnings, catching everybody else. So earnings outperformance of the average stock relative to the S&P 500. So with the table set now, I'm just going to give a quick highlight here of what the earnings snapshot is as of yesterday. We've had a bunch of earnings this morning that aren't included here, but it's pretty similar. It looked pretty good this morning from what reported. So it's more or less in line. So for the S&P this current season, we have earnings tracking 8% ahead on the bottom line, and sales surprises were a little bit more muted, but still +1 across the board, across all sectors. And the best sectors we saw in terms of earnings that had any kind of robust value. So industrials, 10 of 80 have reported their bottom line +5%. Consumer discretionary, 5 of 50, so about 10%. So still early, but 13% plus on the bottom line. That's incredible. We're seeing more cyclicals come back in terms of that. Communication services, information tech, we're +6. So things are looking pretty good. So that being said, I'd like to dig into that, color conversation around what we think about the broadening. So Keith, I'd be very curious to hear, what you're seeing as we begin earnings. What do you think about those kind of dynamics of broadening? Do you think it's going to continue? Do you think it's not? And maybe
we'll talk about the broadening. I mean, you set it up well. I think this is kind of the long-awaited. People have been talking about broadening for quite a while. We've had fits and starts last year. If you remember, value started out very strong, kind of gave it back to value or to growth stocks, kind of back to the Mag 7. I think as we got into fall late last year, you started seeing this broadening out, and I think that's continued this year, and I think that's healthy. We all talked about it. Now, the difference of broadening out, like you said, is it a catch down or is it a catch up? I think right now, so far, I mean, I would say the market's performing ideally. You're not seeing those Meg 7 names kind of fall apart. They're just kind of chugging along, but they're not chugging along as fast as some of the other names. So the S&P is actually up, right? Because if you look at those top 10 names, that's about 40% of the S&P. You just certainly don't want those to be down 25%. Right. That's a huge headwind for the rest of those, 490 names to play catch up. So they're not doing that. They're still performing well. A couple are up, a couple are down. So mixed bag, which is kind of what you want. You get back to the stock pickers, the name, right? Market that select the ones that you think will do better. And then you're starting to see the broadening out. You laid it out well here. You see industrials, consumer, other areas starting to pick up, and the earnings reports are reflecting very positive. I mean, there's a lot of noise and headlines, but if you take yourself out of the news mainstream and actually focus on company fundamentals, I think we're in a very healthy place, and I like to see what's going on right now. We're not falling apart in the Mag 7, which I don't want to see, and you're seeing these other names playing catch up, and their valuations are lower than the S&P. So you can, I think you're getting earning acceleration, and you're getting that catch up on the bottom 490 is how I'd position it.
Yeah.
Well, within the Mag 7, I think it is interesting. I was looking at rolling correlations, and last year they were like 0.7. So all of them were moving lockstep more or less with each other on a day-to-day basis over the last year. And that rolling correlation has basically evaporated. It's down to like 0.2, 0.3 now. So it's more than cut in half.
Yeah.
So that diversification, that broadening out, Lisa, maybe I'll throw this to you. Why do you think that was, where they were in sync and now they're not? Is it greener pastures? Is it part of this broadening dynamic? What do you think?
No, it's interesting that you mentioned that, because I was on Schwab this morning talking about Meta preview.
Where's the clap? You gave yourself a little clap, Lisa? Maybe somewhere.
Somewhere. We don't know if it went.
We'll blow up our system if we find a clap.
I'm not touching it too much. Anyways, talked about preview Meta earnings as they report today, Wednesday, after their close. And I was also, especially with Meta here, and we saw that in the last earnings report, it was down 11% after they reported. They didn't fall off a cliff. They reported they beat their very consistent history of beating their earnings. So nothing was wrong there, but just the CapEx commentary was just too much for investors to take. I would say this is one of the Mag 7 hyperscalers that kind of doubled down most, but others as well, like Amazon and Microsoft, but they got treated completely differently. Which I think there's more dispersion within the Mag 7 now, and it's more like you said. There's no the Mag 7 is a trade in itself, and we just trade the Mag 7 and call it a day, and everything is good. It's more about fundamentals now, different drivers of the different parts of the Mag 7, and how they are doing, and what actually the business fundamentals are of these companies, which is great, right? Because that should be. These are different companies, even though most of them are in the same sector and kind of doing similar things, but they have different revenue drivers, all of them, different diversifiers, different revenue streams, different. So it's good. I think that we are back in valuing them for what they are, and not just, okay, these are Mag 7 and let's call it a day. So we saw a lot of that. Again, brings the correlation down. I think the times where they move in locksteps are over up from now. they will be kind of scrutinized on different drivers and different
which is very
ways.
healthy.
Yeah.
Which is healthy,
Yeah.
yes. I don't think that this is something bad.
What would it take for them to maybe reverse that and move in lockstep again?
I don't think that maybe like a general AI, the next phase of AI, maybe where they all like again are all participating. We talk about
Or deep sea could come in there too. I mean, the other way,
right?
It could
That would be the other
yeah.
way. Or we talked about like the general AI, you know, the next kind of, what is it called? The next step of it.
The next leg phase.
Are the artificial general whatever.
Oh yeah, right. Yeah, if it goes all the way. Yeah.
Right. So I would say that maybe could bring us back if they're all like in that boat, but I don't think that will happen. So I think it's just different drivers, different monetization, and that looks very different for the Max 7, for example, from Amazon to Alphabet to Meta. So I don't think that we are going back anytime soon to.
Kyle, do you think the broadening out continues, or what's your thoughts on?
Yeah, I do. I think I was a little early on this. You know, I've talked about you know, the small cap renaissance. You know, I wrote a couple pieces, market reflections, earlier last year about that, and I was wrong. I know 8, 9, 10 months of that, and now we're finally starting to see that. So I guess better early than never.
Than late, yeah.
But that being said, I think it does continue, and I believe it goes ultimately back to the cash is king. You know, we've talked about this and beat this drum because it consistently and empirically is right over time. Is, you know, earnings drive markets, and yeah, there are animal spirits, and that is beneficial for more short-term trades. But at the end of the day, it really is earnings driven, and I think there's a confluence of a lot of, you know, helpful things for the market, and that would be, you know, easier policy decisions from the Fed, allow those zombie small cap and SMID cap companies with more floating rate exposure on their debt to be able to, you know, not be in that zombie state. But I think
less of a headwind,
less of a headwind. So I think stock picking is definitely coming back. So that rolling correlation, and
which is generally more important in the small cap space anyways,
totally,
right? To begin with.
But even in that,
it was always important in that
space.
Space.
Yeah, totally. And but I would say, you know, your comment on that Mag 7 group, you know, there was this little chart that we have here that I pulled from Goldman, and it's very, very interesting to me, at least. And what it shows is mega cap tech forward 12-month PE valuation, so NTM PE. So what we can see here is across Google, Broadcom, Apple, Microsoft, Meta, Nvidia, and Amazon, the dispersion is really amazing. And what it shows, I'll give you the tail ends here for, you know, our listeners. Google is 29 times forward PE, and it's at the 95th percentile valuation versus the last 10 years for itself.
I mean, Google had like a fabulous renaissance. I mean, that's not far. That's not long ago.
A year ago, this was at the 5 percentile.
Yeah, but the absolute laggard in the Max 7.
Yes.
It's like, oh my God, they are basically
AI is going to kill surge.
Kill their surge.
Well,
they
the DOJ and everything else with it.
And now they're like the absolute winners.
Right.
This is kind of, that's how fast it can go, right?
And then on the other end of the spectrum, we've got Amazon, which is the exact same multiple, 29 times forward, but they're at the 5th percentile relative to the last 10 years for itself. So you've got kind of a tale of two cities here, where you had Google, exactly like you said last year. If you were looking at this chart, it would have been inverted. So Nvidia is the next on that tail end, you know, it's 24 times forward, and it's kind of 5 to 10 percentile versus its last 10 years. So it's really amazing. So you think about that breakdown of the correlations, and, you know, there is value to be found in these growth names. You know, it's not an either or. So I think stock picking comes back for sure. And it's not just, you know, blindly picking like it was last year. So so that being said, you know, I think earnings will be interesting to continue to unfold. You know, if the metas, the hyperscalers come in and they just, you know, beat everybody out of the water in terms of expectations, I think you could see the correlations come back, kind of snap to. But if we continue to see the average company just kind of rock and roll as they have, I think you're going to continue to see the broadening. So if that does happen, Keith, who do you think stands to benefit the most? Are there certain sectors, industries you're looking at where you're starting to lean into to get ahead of that puck?
Yeah, I mean, I think the economy is healthier than people anticipate, or going forward is going to do a little better. So an area that hasn't really performed, been a little bit of a mixed bag. I think we've talked about it before, is consumer discretionary. I think that's kind of that lower end demographics, the K recovery, the K
bottom leg of
economy,
the K.
the bottom
But
leg of the
also,
K
like when you look at
curves up a little bit.
luxurious brands, they haven't done all that well
No.
as well, like Hermes or like
Keurig or-
Yep. They were
Yes.
like also laggards on the upper K shape, so it's interesting.
Yeah, so that's where I'm kind of focusing a lot of time there, and industrials is another area, but that's such a wide variety. I mean, there's all kinds of different industrials, but generally speaking, if I had to pick a sector that's from a sector level, that's kind of been a laggard. People throw out healthcare, but again, healthcare is such a hard.
UNH yesterday made it look hard.
Yeah,
Ooh,
UNH, it was just a terrible.
brutal.
Yeah, and then
It was just again, that's basically there was a tweet again, right?
Right.
Well, you get the government with the reimbursements changing it from 4 to 6 is what everybody expected, and now it's going to be 0.9.
Yeah.
It's like that's the problem with healthcare, right? You just you can get sideswiped on things. So that's why consumer discretion, I think there's an area which, again, what was wrong last year is Amazon. It's one of my favorite names. And to your chart, we just talked about valuation. It's in the 5th percentile.
Yeah.
It's
I think it was just like so disappointing.
Yeah.
I would not have expected that.
And the quarters were
opposite.
good,
So
it's a little more like disappointed fundamentally. So,
So,
but yeah, that's kind of half their business is retail. I think you've owned some of the dollar stuff in the past. I think that's kind of the area. Then you get even to quasi home builders, which is industrial / consumer. I think that's could be potentially more interesting as rates, slowly come down. If that bottom end of the consumer does better, then I think you can see some activity there, and low expectations. Those could surprise to the upside, I think.
What about you, Lisa?
I think, I still like healthcare, and again, to your point, you have to be very careful what you like. Is it insurer? Is it pharmaceutical? Is it devices?
She's talking her own book right now. Was it Lilly, her number one stock this year?
Maybe
I have to push that a little bit because it's not going well.
Speaking of which, my son's in college, and he texted me. He's starting to finally. He didn't want to look at the markets, but I think he's finally starting to look at them. He's pinging me with different ideas. Yesterday, he pinged me on Lilly.
Oh, did he really?
I should say talk to Lisa.
So I think that's still a very interesting space. We talked about, to your point, Keith, like you said, we talked about a resurgence of healthcare for 2 or 3 years now. It hasn't really materialized, so it's still lagging. But again, so focusing on, again, very, very different drivers for different sub-industries there. I would say insurers, that's kind of a little bit hit or miss. You're very much kind of dependent on the government, what happens there. But I would say devices are still interesting. There's a lot also what can be done maybe with AI, like efficiency increases, which we haven't seen so far as well. But at some point, this can be like a huge beneficiary for the next leg of AI, so to speak. Again, very early that we talked about that last year, hasn't materialized yet, but it eventually can be a huge opportunity. And also pharmaceuticals, right? Pipeline strong companies to focus on these. As rates come down, R&D gets a little bit cheaper as well. There's a lot of consolidation happening and a lot of M&A happening in that space. So there's interesting pockets there. Also industrials, again, to Keith's point, and you're like a specialist on industrials. That's kind of a little bit a mixed bag where you're looking at that space, because there's just so much there, right? But for example, like companies like Eaton, for example, like focusing on the grid, right, and on these investments, and then we still have the reshoring theme going on that kind of went a little bit on the back burner. That was not, I think, not yet materializing as much as people had hoped. But that is a theme that could be interesting. So I would say industrials and healthcare, but very specific areas of that.
How about you, Kyle?
Yeah, I would agree. More the cyclicals for sure, with just the rate sensitivity and the, as the economy kind of settles. And I mean, you look at like the GDP now forecast for last quarter. I mean, they're piping hot,
Mhm.
5.4%.
The second
Amazing.
estimate is
Yeah.
even like higher than like 4.4.
Yeah,
Yeah.
it's up there. So
Mhm.
that being said, if you do see the bottom leg of that K start, kind of coming up,
But what would it need? Because they're struggling.
they are.
But what would it really need? Like, is like really like a 1 or 2 interest rate cut that is expected this year enough to help them out of the misery?
I don't think it's
like what is
you-
needed there to really get them back going?
I would say it's a confluence of a couple different things. I think rates obviously help, more kind of easy money, and that's not always a good thing because there's a balance there with inflation. But I think tariffs kind of settling, we'll see what happens with policy. But I think one of the key drivers is the one big beautiful
That's what I
bill,
would
right? So you think
exactly
about like
point
The
to.
tax return,
the tax returns are going to
be
be, for a lack of a better word, mega this
Mhm.
year. You look at like how big
Bigly.
they're going to be bigly, right? So you look,
bigly and beautiful.
they are going to be bigly and beautiful because you have the salt tax go from 10,000 cap to 40.
That's a big deal.
That is a huge deal. So you're going to see,
no tax on tips.
right,
Mhm.
and overtime,
Overtime,
Mhm.
some Social Security, which I'm
Right.
still not exactly sure what.
right.
what that means.
Yeah.
But that, you look at, info from Goldman or from JP Morgan or any of these, places out there that are kind of aggregating these numbers, and they're not small. So I think that will help dramatically. But, going back to what that drives, it's really that, as Keith said, consumer discretionary, I think, has been a laggard. I think staples is also, which is a bit odd because it's defensive.
Mhm.
It has been so poorly performing. It's the worst performing group in terms of valuations in the last 30 years.
Really?
Yeah, it's
Yeah. Which
valuations.
is interesting because both hasn't worked. Like discretionary and staples are both.
Yeah,
Like,
usually
kinda-
Right,
one or
right,
the,
yeah,
right. Well, and same with healthcare.
Yeah.
So what usually works when people are fearful in the markets
Yeah.
or defensive? So the healthcare, the staples, the utilities, that kind of thing.
Yeah.
They haven't worked. Utilities have because the AI, the grid infrastructure stuff. But so yeah, so for me, I would say, the cyclicals, and then maybe moving to the next little leg of it would be from a style standpoint, value is underperformed. Is, effectively in 2000 kind of 1, 2, 3, like that value kind of Fama French view of how the markets work, and you get paid for,
And
investing.
reversion to the mean. And
Yeah,
all of
mean reversion. That it
Mhm.
just hasn't worked really since the dawn of the internet and the smartphone. That factor as an investment lens has not done well compared to growth.
Yeah.
It's had fits and starts. Like 2022, it came back with a fury. So I do think that we might, as part of this broadening, see some of that, and then also small and mid cap. So I think stock picking is coming back into vogue, and I think there's going to be opportunity there. So
It's
It's
exciting.
a stock picker's market
is a
at the
stock
end of
picker's
the day.
market.
Wow, Lisa.
yeah.
Well said.
So that being said, we'll maybe close on a little bit of a funner topic. Frigid weather. We
Oof.
covered that, so we're hopefully at the end. Usually in Minnesota, I think we saw. What was it last week when we were gone?
It was minus 25, 26. When I
boy.
got up on Saturday, it was minus 25.
And that's air-
Sunday.
that's
That's a normal
ambient.
temperature.
What was the
Yeah.
wind
What
chill
was
with
it?
It
it?
was
The-
minus 40.
Minus 40.
Yeah. Which
It was.
it was cold.
You were
You guys were one in
freezing.
San Diego. What was it in San Diego? A nice 60, probably.
It
Well-
was because they had like the outskirts of the big winter storm. Weren't hit by it, fortunately. So it was on Saturday. It was a little bit cold, but Sunday it came back to mid 60s, and that's enough. It's
Yeah.
like
Compared to here.
right?
It's a
Compared to
100-degree
here,
swing.
right? I mean, I was like, oh, it's colder than it would be this week, but I'm like, where are you coming from?
Yeah.
Right.
You just have to be grateful at
Yes.
some point.
It's a good attitude.
You had interesting temperature stories.
Yeah, the weather
changed
was
from
kind of
one
crazy.
spot to the next.
Yes, yeah. So on Monday, when we were leaving, we were in Breckenridge staying, and it was minus 20 in the morning.
Oof.
And then when we were driving out of the mountains, we got down to Denver, which is in a bowl. And it's always sunny there, I feel like, which I absolutely love. By the time we got down to the city, it was plus 40. So it was a
That's
60-degree swing from
Oh my God.
just an
It's a
hour and a
couple
half
of,
drive.
yeah.
So the elevation that we were staying, I think, was 9,500 feet, about 10,000 feet. So,
Mhm.
you know, up there. I don't know what it is in kilometers or
Me neither.
meters. Sorry.
I'm still bad with the conversions. Like with the metric system, that's
So
well,
are-
no, I guess I would know because it's you're about 2 miles up. So, you know, a 5K is 3.1 miles. So
okay, look at quick math on
yeah.
so you'd be like 3, almost 4K.
Oh, that's up there.
Yeah.
Yeah, that's high.
So, okay. So, yeah. So interesting there. And then maybe last one, because it's coming and we probably talk about this again, but Valentine's is right around the corner and we've talked about holidays and traditions. Do you do Valentine's Day or
Yeah.
no? Do you?
Yeah.
What?
Yeah.
I figured you would.
We
I
do
mean,
Valentine's Day. I mean, come on. It's just like a perfect opportunity to sell like overpriced chocolates and overpriced flowers. Like
Which German and
oh, yeah.
Austrian chocolate. Who doesn't like that?
Yeah, right. Who doesn't like that? But we have a tradition, Dominic and I. He's not huge of a chef or cook or whatever, but once a year on Valentine's Day, he is
Oh, really?
doing
Turns
Isn't
the
you
doing
charm
romantic?
on.
Yeah.
yeah, but he wants to, then overdo it, right? But
Oh.
he's not used to doing it the rest of
normal.
the year all the way. So he always dims the light, and I have to leave the room when he cooks. Not out of sounds very
'Cause it-
romantic,
Yeah.
right?
Smells bad or burn stuff or what?
No, he does it. So I have to leave that I do not see the mess taking shape. And when I come back, he dims the light, not of romantic reasons, but that I don't see the mess in the kitchen. All that
Oh,
much.
really?
Anyways, so
That's the
he's-
tradition. Dim,
Wow.
dim the lights to
dim
cover the
the
dishes.
lights
Yeah.
to cover the mess, but he
Throws a
puts
blanket
effort
over it,
in.
yeah.
So but he's gotten better with so he's making his own pizza now, which is
Oh.
very legit with
Does
his
he
own
He
dough.
doesn't have his
and
own pizza.
He has his own pizza oven.
He
Where do you
does?
put that in? On the
Yes.
outside
Like-
of your deck, or where are you
Is it
putting
like
that?
the
Outs-
The-
yeah, that's-
propane one?
Yeah, propane
Oh,
one.
Where are you
wow.
cooking that? In your garage? You're in an apartment.
Well, on the balcony, we're
That's what I'm
not
saying.
really supposed to do that,
What?
so we
Okay.
kind of
Well,
probably clip that out. But yeah, with the legit pizza oven. So he's gotten better over the years, but especially in the beginning, that was a huge mess.
No,
I bet it
bet you.
was.
Yeah.
Yeah.
But anyways, that's
Yeah.
our little tradition.
Nice.
Yeah,
You-
we what do we do? We well, with kids, I feel like it's
Mhm.
always fun.
Yeah.
I like it. I liked it when I was a
Are
kid.
you decorating? Because I saw like a lot of which we don't do in Austria. We just celebrate the day,
with the
Yeah.
money grab.
but we don't decorate.
Yeah.
But here it's like everywhere is the hearts. And
It's
stuff. It
commercial
doesn't-
consumerism, you know.
Okay.
You gotta be able to sell stuff at Target, right?
Yeah.
Yeah. No, we do the window clings. They're like it looks like jelly, you know,
Mhm.
and you put them on, and the kids absolutely love that. So yeah, we do that, and then the little chocolates and stuff. But
Yeah.
I always like to see the kids because they're happy because it's
Nice.
So
you
the
know,
kids
it's fun.
also kind of get chocolates and
Yeah, at school they do. Well, the school I feel like is way different now from when I was a kid
they
because
don't
they don't really do the
them
candy. And we
now.
at school
And the
we
envelopes
used
in the
to
box
we
and
used to
the-
make the box at school,
Yeah,
and
same.
then you'd go and you put the you do the whole thing or whatever and have a little party. Nowadays it's just like the card, nothing else.
Yeah.
You're not.
I didn't know that the kids are also participating because
Oh,
in
that's a
Austria,
big-
I'm just used for the adults are doing that.
Oh,
When you're in a
really?
relationship, you kind of celebrate the day of love or whatever, but it's not really involving kids or something. It's just like between, partners. Yeah.
Right. Oh, interesting.
So-
Well, now you've got like Galentines and like people
Yeah, with
who
the
are single.
girls
Yeah,
and
right.
yeah.
So
Yeah, no, I have nothing.
now that the
So-
kids are gone, you
Kids are gone. I don't know. I guess I'm about to step up my game. I don't know.
Yeah,
Yeah.
you're gonna have to dim the lights and throw the
Dim
blanket
the
over
lights
the dishes.
and have
I
cook
think
something up, Keith.
I'd be in the same boat as Mr. D. I think if I'm getting behind the
behind the
stove.
curve.
Yeah.
yeah, it's not good. No, we'll go out to dinner or something. But my wife's
Mhm.
generally, again, we talked about this, hard to buy gifts for. 'Cause
Yeah.
we normally buy them during the year, but no,
Right.
we'll do something. Probably something with our dog.
Yeah.
That's
Nice.
how
Louis.
with Louis.
Yeah.
So no,
Nice.
it's February is one of my, if we want to back it up, one of my least favorite months.
Just because it's a weird month.
it's a short month, it's a cold month, it's kind of
You're
getting
over the
s-
cold,
you're
but you
over the
still have 2 months
cold,
at least
And
to
I love
go.
spring. You're not quite to
Yeah.
spring yet. You're kind of, and then you got, you throw a Valentine's Day in there, and then
Yeah.
you got
Are
my
you
wife's
planning-
President's
birthday,
Day.
my wife's birthday, which again, I'm nothing against her birthday, but it's just another gift that I see.
That
It's
you have to
hard-
wrap your
We
head
really
around.
we really tapped into like a
February,
sore
yeah,
spot here.
sore spot. February.
Gifting is
No, I love gifting. It's a problem.
Mhm.
It's just harder to
Yeah.
do it. When
It
you
is.
get older.
I completely
because you
agree.
have everything
It is
and-
hard when you get it. When you
Yeah.
get it,
When you
because
get
you're
it,
an adult.
Yeah,
So-
when we were kids, it's like
Yeah.
Christmas is a
Right.
huge deal because you never got anything all year
Right.
long. Going out to dinner a couple times a year was a big deal.
Right.
Now it's like it's
Yeah.
kind of normal course
Right,
for the
right,
week, right?
Right.
So,
It makes it feel less special.
Yeah.
Are you
Yeah.
planning on a spring break? Because you said it's still not.
I don't think so this
yeah.
year. Last year we traveled quite a bit internationally, so I think this year I have to
Little
recoup.
karma.
You're gonna
Yeah.
finish your bathroom at home.
Yeah,
That's- that
that's
is-
the update. That's actually my Valentine's gift,
Oh,
and
look
and,
at that.
and my
You
wife's-
purposely sandbag it so it can be
Yeah.
done on Valentine's.
I told Emily, I said, I think this year Valentine's Day and your birthday are getting wrapped up with this bathroom.
There you
model
go.
Finish.
There you
Oh,
go.
5 months later, it's just.
I mean
a
that
disaster.
needs to be acknowledged as well. Keith is doing the bathroom all on its own.
Yeah.
Everything
We'll
like
have
the
to have a
He
pipes
showed me.
and the
He showed me
plumbing
pictures.
and the-
It's gorgeous. He's
Oh, I wanna
doing
see
a great job.
pictures.
Yeah.
Yeah.
We'll have to do more
Yeah.
on that one.
Maybe
Yeah.
up on the big screen here.
There you
Yeah.
go.
All right, everybody. If you like this, like and subscribe. We will see you next
Oh,
time.
and we have to tease for next
Oh,
week.
oh,
because we
oh,
teased
yes,
last
right.
week for this week, but
It was a tease.
it was a tease and we didn't forget about it, but we organized
gonna be
a
so good.
very, very special guest for next week.
Yep.
So we kind of saved the topic for the one and only.
And what was the topic again?
the new SMID cap portfolio that we
Oh,
introduced.
Stay tuned. We
So
have a
stay
special
tuned.
guest.
You want to be back for next week
You definitely
because
want to be back.
this is where this will be very special with a very special guest. So stay tuned.